Chapter 11 deals with corporate reporting and analysis. In this chapter, we're going to focus on a legal corporation. So a legal corporation is an entity that is created by state law, and the corporation exists separate and apart from its owners, and it has all the same rights and privileges as an individual does. It can enter into contracts, it can buy property, it can be sued, so it's a separate legal entity. It can be publicly held, which is mostly what we will talk about, or it could be privately held. So the reason that major businesses choose to go as a corporation is because, again, it is that separate legal entity. There's limited liability, and that limited liability means that if you invest $10,000 in that company and say something horrible happens and there's a big lawsuit and they go bankrupt, nobody can go after your personal assets. So your house is safe, your retirement is safe. You'll lose that $10,000, or you could lose that $10,000 you have invested, but everything else is protected. You can buy and sell, so transferable ownership rights. You could say, okay, I'm done with this $10,000 investment and I want to sell my stock to somebody else. It's a continuous life, so the owners, the stockholders could all die, and that company continues to exist. So it's not tied to just a person. No mutual agency for stockholders, and then easier capital accumulation. So meaning that that you can issue more shares of stock. You could issue preferred stock. There's a variety of ways to raise capital. You could issue bonds like we talked about in the last chapter. Than just if you were a sole proprietorship or a partnership. So the disadvantages are that there is definitely more government regulation, especially when it comes to payroll and employees. And then corporate taxation, what they say for a corporation is that it's double taxed. So the corporation itself pays income tax on its net income, and then if they choose to distribute the income to their shareholders in the form of dividends, those shareholders are also going to pay tax on that dividend income. So here gives you a nice little pyramid of a corporate organization. So again, the stockholders at the top little triangle are the owners. Then they elect the board of directors. And then the president, the vice presidents, there's normally multiple vice presidents, any other corporate officers, they're going to report to the board of directors, and then the employees of the corporation report obviously to the president and the vice president. So the rights of the stockholders are that they can vote on any important issues. They can vote on who is in the board. They can elect the board of directors. They can sell and dispose of that stock. They could purchase additional shares of stock. If the company is going to pay out dividends and they have the availability to do so, they can receive those dividends. And then if there was a liquidation, if the company was to go under, they would then share in any of the remaining assets of the corporation after the creditors and the preferred stockholders are paid. So we get into the basics of the capital stock. So when they go and they file with the Securities and Exchange Commission, they'll say we want to sell 500 shares of stock. So once that's approved, those would be their authorized stock. So they're authorized to sell 500,000 shares. The par value, sometimes it could be $1 par, it can be $5 par, it can be whatever arbitrary number the company wants to assign to it. Doesn't mean that that's what it'll sell for, and normally it's lower than what they expect it to sell for. They could also issue it as no par stock, which has 0 par value. Again, and then more and more companies are doing that in today's market, just because, again, it helps free up their capital. The stated value, so it would be no par stock, but it has a stated value like $1 a share or $5 a share. Then in the stockholders' equity, we'll have that common stock, and then we'll also have paid-in capital, which would be the total amount that we get paid when we do sell the shares of stock. And then retained earnings also rolls into the stockholders' equity, and our dividends are paid out of our retained earnings. So again, like I said when I just discussed the par value is an arbitrary amount. It does not equal the market value. It's normally less than what they expect the market price to be. And there's the three different classes: par value, no par value, or stated value. We'll have the account, the common stock, that's what's going to go. If we have a par value or a stated value, that's what goes into our common stock account. Anything that we sell it for over the par value or over the stated value goes into this paid-in capital in excess of par. And then our retained earnings, again, is where our net income and our dividends roll into. So when we issue par value, they issued $30,000 $10 par value stock for $300,000. Cash comes in, and then we record it at par value. So in this case, they didn't sell it for more than par. They sold it right at par. Now, say they sell it for more than par. So now they sell the 300,000 shares of $10 par value stock at $12 a share. So the cash is going to come in at the $12 a share. So cash is $360,000. Common stock is at par value at the $10 a share. And anything over that, so what we need to make this entry balance, goes to the paid-in capital in excess of par value common stock. So then here, as we're looking at our balance sheet, we've got our common stock at par value, we've got the paid-in capital in excess of par, and then we have our dividends, our retained earnings. If we issue no par value, then we don't have any paid-in capital. Whatever cash we get, we debit cash. Whatever value, again, is $40,000, all of that is going to go to the common stock, no par value. Stated value is basically the same as the par value. So the cash comes in at the price that we pay, so $50 a share for 1,000 shares. The stated value is $40, so that's what goes to our common stock. But again, notice it says stated value instead of par value. And then anything over that goes to paid-in capital in excess of stated value common stock. So the only thing that changes is instead of saying par value, we say stated value, but the basic setup is the same. Let's say we issue shares of stock and we don't get cash. We issue it for something other than cash, some other asset. So in this case, we issue 4,000 shares of $20 par value stock for land valued at $105,000. So the land is going to be valued at the $105,000. Our common stock is the 4,000 shares times the $20 par value, so $80,000. And then again, anything excess or whatever we need to make this entry balance goes to paid-in capital in excess of par value, comma, common stock. Okay, what if we paid it to our attorneys who helped us organize and get this stock available for public purchase? That's going to go to organization expense for the price of their invoice, $12,000. Then we 600 shares times the $15 par value is $9,000 to common stock. And then the excess goes to paid-in capital in excess of par value, comma, common stock. Okay, then cash dividends, that's the way of the companies to pay their shareholders their share of the net income. So they have to have a sufficient balance in their retained earnings, and they have to have cash. If they are growing and they don't want to give cash back to the owners, they will just pass on dividends. So they may not pay dividends for years. But once they've grown and they're kind of stable, then they'll start to pay those cash dividends. So there's different dates. There's a date that the board of directors declares the dividends and that the company is going to record the dividends paid and then the dividends payable. Then, like so many days later, it's going to be to all stockholders on the date of record. No entry is required there. The dollar amount doesn't change. It's just who are we paying changes. And then it'll be a certain date that it'll actually get paid. We'll take it out of the liability and credit cash. So here are again the journal entries. So we're recording the liability. So we debit dividends paid, or ultimately that goes into retained earnings. And then we set up common dividend payable. no entry is on that required on the date of record. Then when we pay it, we'll take it out of the common dividend payable and we'll credit cash. Companies could, if they don't have the cash, they may decide, well, let's pay a stock dividend instead. So they may do that just to make their owners happy, or they could want to reduce the stock price. So a stock dividend is going to increase the shares outstanding, and that's going to ultimately reduce the value of the stock. So a small stock dividend is less than 25%. A large stock dividend is more than 25%. And if they do the large stock dividend, they're primarily doing that to reduce their stock price. Another way to reduce the stock price is to do a stock split. So if you had one share, then after a stock split, you may have 2 shares, or you may have 3 shares. They'll say it's a 2-for-1 or a 3-for-1. But what happens then, the par value, so if it's a 2-for-1 stock split, you had 100,000 shares at $20 par. Now you have $10 par and you have 200,000 shares. So twice as many shares at half the par value. And that also, it will reduce the market price by half. So this is a nice little table that shows you if you have a cash dividend, what changes. So our assets go down because we pay cash, and our stockholders' equity goes down because retained earnings goes down. If we do a stock dividend, it doesn't increase our assets or our liabilities, but our common stock goes up, our paid-in capital goes up, and our retained earnings go down. If we have a large stock dividend, our common stock goes up, and our retained earnings go down. If we do a stock split, nothing changes. All that changes is the par value and the number of shares. Companies that are publicly traded can also choose to issue preferred stock. It's not required. Common stock is required. Preferred stock is an option. Oops. So they can. How we do the journal entries, though, is the same way as the common stock, except for now we have an account called preferred stock, par value, paid-in capital of excess of par, preferred stock. And it's the same thing, though. So it gets recorded at par value, cash comes in at the price, and then the excess goes to the paid-in capital. If we were to look at our stockholders' equity again, it's similar that we've got the preferred stock, the paid-in capital right below it, then we have common stock, and we have retained earnings. So companies issue preferred stock because it helps them to raise money, and then they don't have to, like the preferred stockholders don't have a voice in management, they don't have voting rights, but they're kind of a lot more like the bondholders, where they will get dividends if the company pays them. So with bondholders, you have to pay them interest. The preferred stockholders, the company could still pass on the dividends, but if they do pay dividends, the preferred stockholders get it first. So we have cumulative versus non-cumulative. Cumulative preferred stock means if they do pass on those dividends, they're going to have to catch up on all the dividends that are in arrears or past due. Non-cumulative means you don't have to catch up on any of the past prior years, but the current dividends will still be paid first to the preferred stockholders over the common stockholders. So here's an example. If they declare $5,000 of dividends, and in year 1 and year 2 they declared $42,000. So in year 1, if we have preferred stock that is really $9,000, and we have $4,000, so the whole $5,000 went to the preferred stockholders. That would leave $4,000 in arrears for year 2. So then for year 2, when they pay the $42,000, they got to catch up the $4,000 that they didn't pay in year 1, then pay the current year, so they owe the preferred stockholders $13,000, and then the remainder then can go to the common stockholders. If it was non-cumulative, you would just pay the whole $5,000 in that year 1 to the preferred stockholders. You don't have to catch up anything in arrears. You just pay the current year to the preferred, and then the remainder goes to the common stockholders. Then we have treasury stock. So companies will buy back their shares of stock in the open market, and then we call that treasury stock. And how we record it is whatever price they pay. So they buy 1,000 shares at $11.50 a share. We create this treasury stock, common, and then we credit cash. And then the treasury stock is a debit balance, which means it's a contra equity account, and it'll reduce the equity on the balance sheet. Then when we go to sell it, if we sell it out at what we paid for it, that is ideal. So cash comes in for $1,150, and then we take it out of our treasury stock. But that would be rare that we would sell it back out at exactly what we paid. More than likely it'll be a different price. So what if it's more? So then now we sell out 400 at $12 a share. So 400 times the $12 gives us cash of $4,800. But remember, we got to take it out of the treasury stock at what we put it in at. So we bought it at $11.50. So 400 shares times the $11.50 that we paid gives us $4,600. So then we sold it for a little bit more. But we can't take a gain on our own stock. That would be wrong and not according to GAAP. So what we do is we create a paid-in capital, treasury stock for that excess to make that entry balance. Now what if we goes the other way? As long as we have a balance, in that paid-in capital treasury stock, we'll just reduce it out of that. If we ever had a problem that we reduced more than what we had in our paid-in capital treasury stock, then we would have to go to retained earnings because we can't have a loss on selling our own stock. Our ratio for this chapter is our earnings per share. So that's our net income less the preferred dividends if you have any, and then divide that by the weighted average common shares outstanding, and that will give us a price per share. Also the price to earnings ratio, so the market price per share, again, which would be what it closed at on the stock market, and then divide that by the earnings per share. So that's what we just calculated here. So take that into the market price, and that gives us a ratio called the price per earnings ratio. And then we have a dividend yield. So if the company does pay out those cash dividends, take the dividends per share, and then divide that by the market value per share. So if you had $98 invested in that shares of stock, what type of cash dividend are you getting? So what are you actually earning on that investment? Okay, so that is it for that.